It's a pretty weird market we're in. It's not a great market, and the chief problem right now is it's liquidity as much as anything. And it's not even just junior markets. Even in New York, the liquidity is actually not great. When you look at how well Wall Street's doing in a general sense, the liquidity is actually pretty poor. Liquidity is terrible further down you go down the food chain. There's two ways to look at that. The easy, simple way to look at it is that it sucks, which it does. But the upside of a low liquidity market, if you're someone with a little bit of patience and you're somebody that knows how to trade, you can get pretty good deals on stuff if you're willing to just stay in the weeds and put in stink bids and stuff, because in a low liquidity market, it doesn't take a lot of selling to knock something down 10 or 20%. So if you're a patient type of person, you're willing to wait around for a few months. This kind of market's really good when it comes to picking up cheap stuff. I mean, I've got bids in on a few things right now. Usual disclaimer. Basically, and it's weird. I talk to so many people every day about markets, right? That's what I do. And by and large, everybody tells me they're waiting for something, and by and large, nobody knows what they're waiting for. It's really very odd. Everybody's waiting for the other shoe to drop, but no one knows what the hell the other shoe is. The latest bugaboo right now, in the moment is the debt ceiling talks, but it's been something. Everybody's waiting for something for the last couple of months. And this has led to, aside from just the market liquidity, it's also a very boring market. I mean, when you think of everything that's been going on out there, the war in Ukraine, all the geopolitical stuff, debt ceiling, yada, 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 it's really quite surprising how low volatility is. You look at Wall Street, it's actually a pretty boring market. It's essentially done nothing for the last 3 or 4 months. It's done some bouncing up and down, but overall, really hasn't gone anywhere. Usually that kind of equilibrium can't last forever. Something comes along to disturb the equilibrium, and it could be either up or down. I'm not promising you it's going to be up. I'm not worried about the market medium long term, but short term, who knows? The one thing that has happened in the last month, though, and that is the chief thing that I think has hurt precious metals in particular. There's another set of worries with base metals, but we've seen this shift, and I think those of you that are subscribers, I'm kind of a higher for longer guy. It's not that I don't think inflation is coming down. I just don't think it's coming down nearly as fast as everybody thought it was 3 or 4 months ago. And more to the point, I don't think the measure of inflation that is the one the Fed pays attention to. They pay attention to PCE, not CPI. They don't really care about CPI. PCE is not coming down very fast. If those of you that saw this morning's latest read on PCE, is it actually popped up 0.1% year over year, 0.1% month over month, which was not consensus, wasn't expected. I just don't think inflation is going to come down that fast. So I'm sort of in the Fed's going to stand pat for rest of the year probably, unless something happens, unless there's an exogenous event, unless something rolls over and the U.S. economy goes into a recession or something close to it. I just do not see the Fed cutting rates between now and the end of the year. We will get equilibrium established, and I think we're close to it again with the gold price. So, that doesn't mean gold's going to $1,200. That means gold's going to more or less where it is right now. Basically for the next little while, things are going to be not that easy. But markets like this are markets where people with experience and people with cash balances, which is rarely me, but people that are sensible enough to their cash balances, that's where they make their money. It's not easy to do, but times like this is where you make your money if you're willing to pick stuff up when the overall market is crappy. And one of the weird things, and again, I'm sort of on the other side of the argument. There's been this argument for a year now, really. We're on the cusp of a recession. I don't see it. I don't see it in the hard stuff. I don't see it in, retail sales. I don't see it in employment. Yes, things are slowing. And yeah, maybe if things slow enough, we get to stall speed. But I don't think we're there yet. And one thing that I wanted to point out, and I've talked with subscribers before, because I find this very interesting and unusual. It's extremely unusual. It's hard to read the way this chart was printed, but this dotted line that goes way up to the ceiling, that's basically soft data. and it's the percentage of soft data readings that are deteriorating. So the highest it can go is 100. Basically, what's happened in the last few months, soft data is up to 60, hard data has dropped down to like 10. This is about a month old. The divergence is actually even bigger now. There's never been a divergence like this before. Nobody understands why this is happening. It's very weird. But you look at the hard data, retail, things like retail sales, employment, not so much manufacturing numbers, but most of the service numbers, anything like that where they've got measurable data points, it all looks okay. Not fantastic, but it looks okay, decent. Anything that's soft, like survey-based, like, a lot of the Fed indexes are actually surveys, like Philly Fed, New York, those, Empire State. Some of that's hard data, but a lot of the main headline data is actually survey data. University of Michigan, again, that was out this morning. That's another one that really traders tend to pay attention to, but it's an opinion survey essentially that gets done every month. Those are terrible. Why are the hard numbers decent and the soft numbers terrible? Nobody knows. Like, it's very, very odd. And that's the one reason why I'm not 100% there won't be a recession in the next year is really because the soft data is so horrible. There is always a chance when the data is this bad that it becomes a self-fulfilling prophecy. It has not yet. You haven't seen spending cut back. I mean, part of the macro series that came out this morning was spending. And it's done a different way. It's not the same as retail, so it's a more inclusive number. Also, increase in incomes. Both those numbers again were very strong this morning. Like, it makes no sense when you look at that part of the survey from U Michigan, and then you look at the overall reading, which is like 56, I think, this morning, which is terrible. Like, that's a terrible reading for that survey. That's like, oh my God, we're all going to die level. But it doesn't seem to be impacting what they do. So I've been sticking with. I'm gonna watch what they do, not what they say. So for me, I just don't see. I don't see a recession coming quickly. Now, this turnaround in events, it was partially stronger macro readings. It's partially, employment leveling off a bit, but generally, looking like Q2 is in fact going to be stronger than Q1 in the U.S. That had impacts on two things. One is rates. That's the 2-year yield. Sorry, that's the U.S. dollar. You can see it's had a pretty big move from the start of the month. 2-year rates, same way. That's a big move for 2-year rates. I mean, they really got nailed coming into this period after the bank run, or the bank walk, if you prefer, which is still ongoing. So I'm not completely discounting the fact something will happen in that arena. It's not solvency problems like you saw in 2008. It's basically just an asset mix match for the banks. All of their loans are long-term. Most of their deposits are short-term. It's difficult for them to go anywhere near the prevailing interest rates in the bond market and have any margin left. Like, they can't go to 5% on savings accounts because they basically got no margin. So they're trying to dance around and keep their customers happy. But we're seeing a continued probably $50 billion a week move out of the banks into money market funds. So it's not out of the question we'll see 1 or 2 more banks on the skids here in the next month or two. It's much more slow moving than it was 2 or 3 months ago, but it is still happening. But outside of that, I'm not seeing a lot to scare people off. But really, when you see that move in yields on the right side, that's really what drove the move in the dollar on the left side. You're seeing an increase in the spread between U.S. rates and other international rates, plus the U.S. appears like it's going to have better growth. That's really what drives the currency in a nutshell. Interest rate differential, growth rates. That's it. That's what drives currencies. So obviously the dollar and rates doing that hasn't been super helpful for the gold market. This gold chart is a longer term one, but you can see where it peaked right here. That was basically the last bank failure. It was right there. That lasted for that was a new high for about 3 minutes. And then it came right back down again. And it's been dropping for most of this month. And again, it's just trading against the dollar, trading against yields. Do we get out of this ditch soon? Soon-ish, maybe? I don't, even though I'm in the higher for longer camp, I don't think the Fed's going to push rates much higher. We might get one, we might, maybe we get 2 more 25 basis point increase. I'm not so sure even about the second one. It's possible that we see inflation turn up a bit again. If that happens, then our real rates go down. That helps the gold market. Anything that looks like it's going to slow down the U.S. economy is going to help the gold market. Excuse my French, but if they fuck up in Washington, that'll help the gold market. Normally I would say absolutely zero chance. Well, no, even this year, there's zero chance of a debt default. I mean, I've seen a lot of that in the gold book space. There is not going to be a debt default. That is not going to happen. Could there be a shutdown of 2 days or 2 weeks or 3 weeks? Well, both sides of the Congress try to scare the other one. Maybe. I mean, and normally I'd say zero for that too. But I mean, there's some real wingnuts on both sides of the House this time around, and neither side. The Republicans only have like 5 votes more than the Democrats, so it wouldn't really take a lot of crazies digging their heel in to screw things up. So I definitely can't discount it. But in terms of an actual debt default, like the boogeyman stuff that you see on some of the hard money sites, like that ain't gonna happen. Like, it's not gonna happen. This again is a longer term chart. This is just the S&P, and I really just put this up to reiterate the point that, for all the Sturm and Drang, this really hasn't done much of anything. It's not hitting new highs, but it's not hitting lows, and it's hanging in there. And the way it's been trading the last couple of weeks, I think the market is pricing in correctly that they just don't believe there's going to be a debt default. I figure there'll be a deal before. We still don't know what the X date is. Yellen is saying it's January 1st. I've seen calculations by people who are doing daily additions and subtractions from the Treasury general account that think it's like the 8th or the 10th. If they stretch it out to the 15th, then they probably don't have a problem at the end of August, because June 15th that's the big filing date for quarterly taxes. So if the Treasury can get there, they're probably okay for a couple of months, even if they don't get this thing settled. I think everyone would like to see it settled and just out of the way so you don't have to hear about it anymore. But barring that, if something's gonna happen there, it probably happens, and it either happens in the next week or so, or it's not going to happen for 3 months. So Wall Street's clearly just discounting it and saying, yeah, forget it. Now, for all of the angst and all of the lack of liquidity in the junior market, the truth of the matter is gold really doesn't suck. It's sitting at about, 1960 right now, which is hardly the end of the world. I mean, sure, it had that all-time high of 2080, but like I said, that was for 5 minutes. The real peak for more than a coffee break was about 2040, and we're sitting at 1960. And there's a couple of reasons for that, and one of them you all know. One of them surprised me, to be honest. The top one. This is just central bank purchasing. These are quarterly totals. So these dark bars that you see, that's Q1 in each of these years. You can see how high. And Q1 is not usually a big time of the year for the central banks to do their buying. They've got their own seasonality for their own reasons. But this is where we're at for Q1. And you can see it's much higher than any other quarter previously. I think odds are pretty good. We see another record year. And central banks I think some of this is, the so-called de-dollarization, and that's another bandwagon I'm not really on. Like, yes, it's going to happen, but these things happen over decades. They don't happen over months. One thing that I think has impacted this is probably Ukraine and the sanctions that we saw against Russia. And it's not that other central banks don't agree or disagree with those. I think that's just driven a few more central banks to say, I think we want to have more of our reserves in something that isn't anybody else's liability, and something that they can't screw with. Not to put too fine a point on it. And by the same token, that would mean most of them are probably onshoring their gold. It's probably not all sitting in banks under Manhattan. The 2 or 3 banks that were under Manhattan until a couple of years ago have been, like Germany and Britain. They've both been moving their stuff out of the U.S. and they just don't want, nobody can see the future perfectly. So they're saying we don't want to be in a situation where they can lock our stuff down because it's territorially, it's in the U.S. So you're seeing more bullion buying and more of that being onshore. So that's been a significant difference. I mean, this is not chump change. You're talking, the difference between now and a few years ago is like 1,000, 1,500 tons. That's a lot. That's a big chunk of the gold market every year. So that's part of what's helping. The other thing that I'm really not seeing it in retail, but I was shocked when somebody sent me a copy of this survey. This is a quarterly survey that Gallup does, and they're just asking people to rank different asset classes. And this time around, And you can see how much of a move it was from last year to this year. This time around, gold is the second, it's the asset class just below real estate that people think is the best long-term investment. Like, what? Like, I'm still shaking my head because it's not something I hear from anybody outside of the space. But this is a fairly large poll that Gallup does every year to rank asset classes. And it seems, maybe it's the central bank buying, maybe it's the fact that it's under $2,000, whatever the reason. I don't think we're seeing a lot of that in the market yet. But I mean, that gives me some hope that there may, in fact, be more of a, we may actually have more of a floor there than anyone who's been a gold bug for any length of time worries about. I think there may be some retail or maybe outside money at some point comes in. I think in terms of the stocks, I think gold probably has to move higher before it shows up. But I find these two charts to be quite comforting. And I'm not a gold bug, and maybe it's because I'm not a gold bug in the strict sense of the word, but I find it comforting that people on a given day don't give a shit about gold are suddenly going, yeah, it's not a bad idea to have some of that in my portfolio. As far as base metal goes, 800-pound gorilla is China. I think we all know that. It's been the 800-pound gorilla for 30 years now. One thing to keep in mind, though, is all of this stuff you've seen about, the energy transition, energy metals, yada, yada, yada. That's a real thing. And if it does unfold at the speed and the scale that everybody in those sectors, and certainly governments that are pushing that agenda, expect it to, the difference that would make in worldwide demand for, electrification metals, and the one I'm talking about here is copper. It's the main one. That's about equivalent to the kind of demand change that we got when China really, really cranked things up in the late 90s and early aughts. And I think if you talk to anybody in the sector in the early 2000s when copper was, 70, 80 cents, and said to them, like, yeah, copper's going to $4 by the middle of the decade, they just go, you're out of your fucking mind. There's no way that's happening. That's never going to freaking happen. It happened. I'm not going to give any crazy predictions. That's why I have Craig. But I do agree with the basic thesis. And because I'm a guy who's been in the mining sector all my life, I understand that even adding 1 or 2% a year to demand growth, it's really, really hard. It's really, really, really hard for the mining sector to do that. Anybody outside the sector just doesn't appreciate the scale of, scale of CapEx, the smoothness of permitting that you need. Because keep in mind, mines are finite, so there's always mines going offline. So to get another 3 or 4% a year, it's not enough to just find 3 or 4%. You got to find 3 or 4% and cover the stuff that's going offline, and have stuff in the pipeline. So you've got a mine coming in 5 years or 10 years. And that's really hard to do. If everybody's assumptions about electrification are right, I have no worries whatsoever about most of the base metals, and especially copper long term. I think it does really, really, really well. Short term, the big concern that's been spooking people has been China. I got this chart like last night. I think it's got to be out of date. I can't believe it isn't. But this is basically consensus estimate of 2023 growth for China. And keep in mind we're talking China here. So 4 or 5% sounds like holy crap if it was one of the other G7 countries. 5%, is barely above stall speed for China. So 5% isn't a great growth rate for them. It's not horrible, but it's not great. You can see this drop off in the last little while. And I suspect, even though this chart's from last night, I think the numbers, the real consensus is probably down around here someplace. And really that's because the post-COVID surge in China, the post-lockdown surge, has really been a bit of a squib. I mean, really nothing much has come out of it. We're not seeing the demand increases. So that's got people freaking out. You've also got the recessionista crowd that's worried about a U.S. recession. But keep in mind, the U.S., on its best day, doesn't account for much of the copper market. It'll account for more if all this electrification happens. But really, in the short term, it's all about China. So if we're going to have some more dips in the copper price, I'm not sure. I don't personally think it's going to go a lot lower, but if that would happen, it's going to be because of what comes out of China. That's the news you got to watch, not the North American stuff. China is simply where the demand is, period. And it's also important to keep a bit of perspective. I mean, I've seen no end of, my Twitter stream is full of people freaking out about copper for the last month because they're all going, oh my God, we're all going to die. Take a look at this increase in the LME warehouse inventories. Yeah, that's a 2-month chart. Take a look at a 5-year chart. There's your 2 months that everybody's losing their crap about. Like, yeah, it's gone up, but let's keep a bit of perspective and really, what you got to be doing in a market like this is you got to look for the right teams with the right projects in the right area, and simply be cognizant of the fact that if it's a crappy 3 months or 6 months for China, or there is a short shell or recession in the U.S., hedge funds are going to hedge fund, and they'll probably knock the copper price back to 320 or 310, but like whatever. You got to keep your eye on the prize. And for me, the prize is longer term, and it's much, much higher prices. And periods like this are where you position in good deals. And luckily for you, I happen to have invited a few of them here. How convenient is that?